My name is Philip. I use JavaScript, CSS and Ruby to make stuff. That's my brother, Milan. We build startups together. Sometimes startups need money. Investors like Mark and Andreessen have money. Investors give you their money. In return, you give them shares in your company. That's called getting funding. Funding announcements on tech blogs are pretty common, and you've probably seen a few headlines like these.
I don't even know what that means.
No one knows what it means, but it's provocative.
Real-world investment can get pretty complicated, with terms like vesting, convertible notes, pref shares, pre-money ESOP pools, and a whole bunch of other stuff. I'm gonna try to simplify that a bit, and show you how investing works with my mom's favorite treat, Smarties. Owning a share in a company means you own a portion of that company. This is Awesome Co. They've issued 100 shares. Let's say 10 of those shares are yours. With your 10 shares, you own 10% of Awesome Co. In a basic shareholding situation, that means you have 10% vote, the right to 10% of the company's income, 10% of the company's assets, and if the company was ever sold, you'd get 10% of the purchase price. How do you value companies and shares? Companies do not have a fixed value. The only true value of a company is what someone's willing to pay for it. That's a problem though, because people don't often buy an entire company. Usually they just buy a few shares. If someone buys one Awesome Co share for 10 Rand and the company has 100 shares in total, then we assume that the other shares are also worth 10 Rand. The value of the company is therefore calculated by multiplying the number of shares with the value of a single share. In this case, that means Awesome Co is worth 1,000 Rand. The logic can sometimes get a bit ridiculous. For instance, you could sell 1/1000th of a percentage of your company for $1, which would value your company at $100 billion. Let's look at how an investment deal works. People often think about investment as involving two parties: the investor, who gives money to the shareholders, and the shareholders, who are selling some of their shares. That's actually wrong. In reality, there is a third party in the transaction, the company itself. The investors give money to the company, not to the shareholders. The shareholders are not selling their existing shares. Instead, the company issues new shares to the investors.
How about now? You still wired in? Security. You issued 24 million new shares of stock.
You were told that if new investors came
along... How much were your shares diluted? How much were his?
Dilution refers to the decrease in ownership percentage as new shares are issued. Let's look at how your shares would be diluted if Awesome Co brings on a new investor. Before the investment, your team had 90 shares, you had 10, and the investor didn't have any. That makes for a total of 100 shares. Let's say the investor is providing 500 Rand of capital and getting 50 shares in return. After the investment, your team will still have 90 shares, you'll still have 10 shares, and the investor will now have 50 shares. The percentage of the company you and your team own is now less than before the investment, as the total number of shares have increased to 150. So instead of owning 10% of the company, you now own 6.67%. Okay, so that's the end of the video. There's still the blog post below, which has a lot more information that wasn't covered in the video. If you have any questions or suggestions for future topics that you'd like us to cover, please comment at the bottom of the blog post.